Welcome back to our program, Academic Market Insights. And we have had a small hiatus for the winter break. Yay, winter break. Gotta love being academic,
Winter.
right? Mhm.
That's part of the
And
fun of being an academic.
it is super fun part of being an academic.
Yeah.
And it's also just fun to hang out with your kids. And I know your kids were home, my kids were home. It was a good time. So today, super exciting topic. We're going to talk about gamma. Now, I'm excited about this topic because I understand this from an academic standpoint. I have covered it many years, more years than I'd like to admit, in class teaching what gamma is. We can talk about it, how it's the second derivative. There's a lot of cool math behind it, and that's what I focus on because that's what I understand. So today we are going to talk about how it's actually utilized in the markets, which is incredibly exciting. So I can't wait to get into it. I haven't seen the presentation yet, so I apologize to all of the viewers. I will be asking a lot of questions. I hope that they are the same questions you are going to be asking. And if you like this video, I'm going to politely ask you to hit like, yay, and for you to subscribe. And as always, if there is a specific topic that you would like to see, you want to see more on Gamma, please let us know. We're very open. We're excited to do this. This is actually something that's really enjoyable about our job. So, Dr. Rhodes. Oh, and I apologize. My name is Larissa Adamietz, and this is Dr. Rhodes. We're going to be saying hello, and we're both at the Kelly School of Business. Yay, Kelly. Okay, with that excitement, Dr. Rhodes, take it off.
I'll take over. I already put the title slide up there. And what we're going to talk about is we're going to talk about we're going to talk about gamma. We're going to talk about the academic side of gamma, but traders and I throw myself into, I'm kind of, I guess I'm a retired trader. And Dr. A has worked for trading firms, been down on the trading floor and all that kind of stuff. And both of us are very aware, and I've even done this, of using trader speak to confuse people.
Mhm.
And what you'll hear guys on CNBC talk about, they're a bit concerned about their gamma risk. And they don't really explain what they mean by that. Gamma risk is really just a risk of a big outlier move in the market that you are involved in. And it really does pertain to firms that are market making and trying to keep the risk associated with the underlying market that maybe they're an option market maker in, trying to keep that risk at a minimum. So we'll talk about gamma and how it impacts the pricing of options, but then get into where this phrase gamma risk came from. So there we go. So I divide up the Greeks into four different categories. And delta and gamma are what I refer to as the price related Greeks.
Mhm.
We have Vega, which is not a Greek letter, but relates to volatility. They both start with V. That's another, I guess, trader speak thing. Yeah, we made up our own Greek letter. Rho, which is the first three letters of my last name, is basically the Greek associated with changes in interest rates, which we don't have that many changes in interest rates, so we don't give Rho does not get nearly the love that it should. In fact, when we were in a zero interest rate environment, we were discussing at the Option Industry Council, which all the exchanges were members of, we're actually talking about not using Rho anymore in some of the educational materials that we did. But the idea that eventually interest rates would come back and we'd have to redo them again. So we did pass on that one. And then theta gives us an idea as to how much an option is going to lose in value just based on the passage of time. So you got time, interest rates, volatility, and then the underlying price. And the underlying price, in my mind, is the most important factor that you take into account when you're thinking about trading an option contract. And delta is directly associated with the price change. You'll, if you ever hear me talking about an option and an option in the delta on the option, I'll say things, and I'll use this terminology today. I'll say things like, well, we would expect the option to be priced at about. And the reason that we would say that the option would be priced at about is because gamma, which is the delta of delta, delta is the derivative of the stock price change. Gamma is the delta of the delta, or how much we expect delta to change based on changes in the underlying. Well, if the delta is changing around as the underlying stock moves around, that means that the price change, the price impact of underlying price changes is changing as well. So delta gives us an idea for really small price changes, but when we have large price changes, we might need to take gamma into account as well. So this is basically what I use when I introduce delta and gamma. I have a lot more slides, and I talk about puts and calls and the price moving up and the price moving down. I'm just going to talk about a call option and what we expect from the call option based on a $1 price change in the stock and knowing what the delta is. So probably including too many 40s in here, but is what it is. We got a stock trading at 40, and the 40 strike call is priced at $3. The delta for this call option is 0.5. And typically, when the stock price and the strike price are very close together, you would expect the delta to be very close to 0.5. As the stock price moves up relative to the strike price, if the stock price goes from 40 to 41, we would expect that delta to increase as well. If the stock price goes down, we would expect that delta to decrease. And that shifting of the delta with changes in the stock price actually impacts the option price. Now, if we only take delta into account and the stock goes up by $1, we basically can guesstimate that the 40 strike call, if we go, time hasn't passed, interest rates haven't changed, volatility doesn't change, we just had the stock jump from 40 to 41. And based on that jump from 40 to 41, we would estimate that the call price would be up by 50 cents. Yes.
So I have a quick question, and I apologize. It took me a few moments to find the raise your hand function again on Zoom. Why would a option that has a strike price and it's trading right around its strike price, why would it have a delta of 0.5?
We get into the delta using the Black-Scholes model, but the logic behind that one is people like to think of delta as odds. And notice that I have 50 cents or 50% there. So 50 cents, that's how much that's how much we kind of expect the option to change in value based on a $1 change in the underlying. Well, 50% of $1 is 50 cents. So they give us the same answers. But when we talk about delta in percentage, you will hear option commentators say that is considered the odds of that option being in the money at expiration.
Got it.
And based on random walk and a normal bell curve, we would expect if a stock's at 40 and we're 40 is kind of our benchmark there, 50% chance we're going to be above and 50% chance that we're going to be below. Remind me of that when I talk about delta in just a second.
Okay.
So because the next example gives me or what I'm doing as I go along gives us a better idea of the changes, et cetera, and how delta really behaves, and also the odds. So we're right back where we were. Stocks at 40, we got the call at $3, and we've got that delta of 50%. So let's say the stock goes up by $1, and we go to check the option quote, and the option's at, oh my goodness, and I bolded it because it's different. The stock, the option has gone up by 53 cents, which means that you did a little bit better than the delta.
Mhm.
and we attribute that extra 3 cents to gamma. The delta is changing as we move along, and I, I, what I actually, and I basically have made these numbers up for the example because I want them to be nice round numbers, but that extra 3 cents comes from gamma. And that means that and then with the stock now at 41, the new call delta is 56 cents. The gamma was 6 cents. With a $1 price change, the option price benefited by about half of that, and we got 3 extra cents on the upside. And the new call delta is now 56 cents as opposed to 50 cents. If we had gone down, the call would have lost a little less than 50 cents if we had gone down by a point, because the delta would not have gone, the delta would have held up a little bit as the price goes down. And now with the stock at 41 and the call delta at 56, we can say that now the option market is pricing at a 56% chance that that option will be in the money at expiration. Now, were you getting ready to ask a question
I was just
before
gonna say,
before?
well, that sounds better. So if
Does
you're,
it does sound better,
Mhm.
but market makers are supposed to basically be as market neutral as possible. And we often say that they should be delta neutral. Being delta neutral is pretty easy. Being gamma neutral is pretty difficult. So if we're a market maker, and I'm going backwards before the stock price changed again, let's say that the market maker took the other side of an order selling that 40 strike call. So they would buy a 40 strike call. And with the delta of, and each call option represents 100 shares, with a delta of 0.5, if the market maker wants to be delta neutral, after they bought that 40 strike call for $3, they would turn around and sell short 50 shares at 40 at the market price, and they end up with a portfolio delta of 0. Now,
Mhm.
market makers, they're for some markets, I think at one time, Apple had almost 10,000 individual options outstanding. So if you are a market maker in Apple, you're quoting several expirations and you're quoting a lot of options. So every time you take the other side of an option trade, you're doing a trade in Apple as well to try and keep yourself delta neutral.
Got it.
So now that the stock has gone up, that we are now not delta neutral anymore. But and I did use an example where you made a little bit more off of the I had the option going up by 53 cents. In fact, that price should be 53 and not 50. 353. But I had the option go up by 3 cents, and our short lost 50 cents. So we made 3 cents off of that. Uh, so it wasn't too much of a negative, but if we're not hedged properly and the market moves against us, again, we own the 40 call. If we had not hedged ourselves properly and the market went down, we would have lost more on our hedge. We could have lost more on our hedge than we made off of the option that we own, or we might lose more off of our hedge off of an option that we're short. So market makers are continuously trying to be as close to delta neutral as possible. And delta neutrality really keeps you out of trouble, with the exception of large price changes. If you show up on a Monday morning and this stock, let's say, we were short 50 shares and we were long the 40 call, and the stock's down $5 or $10, we're going to lose more from our call option than we make off of our short stock position. And we're going to have to scramble very quickly to get back to delta neutral. That's why when overnight we get some news and we've got excess volatility, individual stock price changes in the first 15, 20 minutes of a trading day, when we've got a big overnight change, it's so volatile, and it's because so many market participants that are trying to hedge themselves with derivatives and have a certain position on have to make a lot of changes very quickly.
Yeah, I'm so
Yes.
glad you talked about that. So Dr. Rowe and I have been similar institutions for a long time. And one place that we were both at was a place called Illinois Institute of Technology. And they would put out these funny t-shirts. And one of the t-shirts had a saying on it, and it said, "Smells like gamma in the morning." And it was one of those t-shirts that I didn't quite get, but I knew all of my buddies would just crack up laughing. So from what I'm understanding, if I'm hearing this correctly, that idea that there is a lot of volatility that have maybe happened overnight, and now people are scrambling to reposition their portfolios. And then
Trades
the
for
other
the
thing,
yeah, go
go
ahead.
on.
No,
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 go
no,
on.
go. All right. I was just going to say option traders tend to, even if their overnight position disconnects, they tend to benefit from excess volatility. It
Okay.
brings more trading volume in. It also typically with excess volatility, you'll see a bit wider bid-ask spreads. And they're part of the reason they're doing that is because they're trying to get a bit more of a market edge relative to the fair value of the different option contracts that they're quoting. And also, when you get the big overnight move, if you have people that owned puts, if it was a downside move, they may want to take profits on those. If they
Mhm.
were short them, they may want to get out of them. But there, to quote Eddie Murphy from the back of the limo and trading places, gamma in the morning, that just means they're panicking.
Yeah,
They're panicking. And
sure.
we talk about gamma risk being a large, just a large price change. Because we're both kind of involved, we're involved in the financial markets. Periodically, I know you get questions about what do you think the stock market, blah, blah, blah. If I'm not really in the mood to talk about it, and I apologize to anybody I've given this answer to, I'll often just say that I'm very concerned about downside gamma in my portfolio. Basically, I just said that I'm worried about losing a lot of money.
Sure.
That's it. So that's what gamma risk is for option traders, though. So when you hear about and gamma risk will be higher going into an inflation number or the for broad-based index options or for the non-farm payroll number. Gamma risk is greater for individual stock options when we have earnings announcements. And what you see is the premiums, all else being the same. IBM options are a lot more expensive the week of earnings,
Hmm.
the 4 weeks that they report earnings, versus the other 48 weeks out of the year.
Sure.
And that is market makers increasing the prices because they're a bit worried about gamma risk.
And it's interesting you say that. One of the firms that I worked at, the traders had said to me, "We don't really hedge for delta, but we do hedge on a nightly basis for gamma." And it was a very conscientious, we're not worried about these smaller movements. We're not, but it's those outlier movements. And that's what we hedge against for specifically the overnight.
Yeah, and actually what I used to I'm gonna take this down and talk to you. Where are we? We used to, I was fortunate enough to be in education at SIBO, and if I wanted to go into the S&P pit and ask guys what's going on, I could do that whatever I felt like it. I didn't abuse that privilege. But one time I saw a market making firm um, basically pay more than the fair value for some options. And somebody was offering, they basically, a public customer was offering to sell something on the offer side. And it was late on a Friday afternoon, and the market makers bought some out of the money puts. And I asked somebody from that group after the market was closed, I said, why did you guys give up that edge? And he said, well, we had gotten some instructions that some of our gamma risk was a bit high for the weekend. It might have been a weekend where, when we're in a higher volatility market, people are a bit more concerned about the weekends. So market makers will give up the edge to reduce some of their gamma risk, especially if their risk manager is telling them to do so.
Sure.
Uh, and that's why, and again, that's why professional traders use that gamma risk phrase an awful lot. I don't think they're using it to make themselves sound smarter than the average trader, or doing things like, or trying to confuse people. It really is the big risk that they're most concerned about.
Right. And again, from an academic standpoint, we talk so much about delta, I think because from an academic standpoint, it's so much easier to deal with, and it's easier to explain, and it's easier, you can go into, well, here's the probabilities, as you said, there's a random walk, and those are fun things to lecture on. And one of my favorite lectures that I also like to do, and I don't know how relevant this is, but I'll have students build a delta gamma neutral portfolio, which is then just adding another option embedded into the equations. And then you have three positions, three unknowns, and you come up with the weights for each of these. But which is kind of fun to do from an academic standpoint, but I don't know that anybody actually would build out a portfolio like that.
There's a little discretion around it, as far as worrying about the gamma risk, and the market makers are never really able to get purely delta neutral as well.
Right.
So you'll do I'm going to shift over to S&P, just because that's where you would see the order occur and hand signaled, and then you could talk to the people about what they did to hedge the trade. And typically, if a firm's a bit more bullish than bearish, and the actual number of S&P futures to trade is 33 and a half. If they're bullish, they may buy 34. If they're not as
Right.
bullish, they may only buy 33 to hedge themselves. That's
Right.
it's so they're never 100% delta neutral, but they try to get very, very close to it and incorporate some discretion into that. I might I'm teaching I'm teaching a more practical derivatives class, as kind of an experimental class at Kelly this semester, and I might try to make them and we trade on interactive brokers together in the class. I might make them try to do a delta and gamma neutral the best that they can. Um, you got the
It's
wheels turning on that one right now.
well,
And we'll know which students watch my videos.
sure.
We could
That's funny. Um, and I also would like to give a small shout out to somebody that we both know. Dan Pazzarelli's book
Oh, yes.
has
Yeah.
a really good example of trading gamma and gamma scalping. And I have found that I've read several, again, because this is not in my wheelhouse, but that was, I think, one of the best examples that I could find in a book. Yeah, you're looking for the book?
Couldn't find the
Uh,
book. Sorry. But yeah, he's got, it's kind of like I'm associated with VIX, and Passarelli is kind of like the option Greeks guy.
yeah,
And
and it's
he does a great job too. And like
he
you said,
does.
we both know him. He did it through. See now, we're giving you a shout out, Dan.
Of
There you
course.
go. So there's trading the option
Yes.
Greeks. Oh, Brodsky wrote his. Brodsky wouldn't write my forward to the VIX book. Now I'm kind of hurt. But yeah, this is. I have both of these books. I have both of Dan's. Excuse me. There's Dan looking pensive and all.
Hmm.
Yeah, The Market Taker's Edge. And then his first book was Trading Option Greeks, which I think he wrote the Trading Option Greeks when he was still at SIBO.
And that's the book that I have, the Trading
The
Option
first
Greek.
one. Yeah,
Yep.
I have all three of those, but Dan does a great job with that. In fact, Dan and I are doing we're going to do a 2025 preview together on Substack. They're starting to do videos on Substack. We're doing that in a couple of weeks.
That's
So
exciting.
it is very exciting. So, all right, everybody knows what gamma risk is now. You know how to be a little bit of a smartass to somebody if you really don't feel like talking about the markets. You can say, I'm worried about my downside gamma risk. And maybe we can make up our own t-shirts that say nothing better than the smell of gamma in the morning. I
I
like that.
know, that's great.
I might, if I did it, it would be there's nothing better than a VIX doubling in the morning. That's a volatile day. So
I think
yeah,
I'm going to deviate slightly off topic, but another one, and my father would wear this shirt all the time. It's a fixed income humor. And he says, I might not be mature, but I have a long duration. And then I thought, "Damn."
absolutely love it. That's fantastic. So, and yeah, I could deviate into duration and modify duration and how that relates to delta and gamma, but that would be a story for another day.
It
So,
would be. And we're
yeah,
looking forward. We will do that one because everybody loves fixed income in Delta.
of course it. Absolutely. So, do you want to
Okay.
take us out, or do you want me to take us out?
Yeah. So if you enjoyed our discussion on gamma, please hit like and please subscribe. Also, if you enjoyed this, check out Dan Passarelli's books. They are outstanding. Um, Again, thank you so much, Dr. Rowe. My name is Larissa Damietz. You can call me Dr. Alpha, and we are here to take real world examples and talk about how we would talk about them in our classroom and are open to any suggestions. With that, thank you so much for joining us. We've really enjoyed ourselves and have loved talking about gamma in the morning.
Fantastic. And there's a link to Passarelli's books right below
Yay!
here. So there.